All right. Welcome to the stream, everyone. Dfi-nancial Fridays. I'm excited to be here to talk a little bit more about what we do best, about the
Yep.
markets, and some financial planning topics. First, I'm Alfred from Diversified Capital here. We've got Raymond joining us again. Raymond, how are you doing?
Doing good. How's everything going with you?
Well, I think my favorite part about Dfi-nancial Friday is it's Friday.
Yeah, I definitely agree with that. I definitely agree with that as well.
Yep. And I think it's nice to end the week being able to talk to you guys on our show here and just sharing with you a little bit of the thoughts that we have going on because a lot is going on, right? I'm talking
Yeah.
about if there's a perfect time for us to have started this show, it's been the past couple weeks here because my God, we've got a ton of things going on in the market. We're here to simplify some of that for you guys. We are also headed towards the end of the year here. So today, our financial planning topic that we're thinking about talking through with you is one, how do you deal with investing in the markets when it's chaos out there, right? Like, what do we do? Why are the markets up? Why are they down right now? How do we isolate some of that noise so you can actually get invested, right? We're going to talk to you guys about what we've seen with our clients, some of the things that they've done, some of the things that maybe we wish that they wouldn't have done, right? In terms of maybe having some cash on the sidelines, like going through the process itself, giving you guys some things to anchor your strategy on. Okay. And then we'll finish off the show talking a little bit more about just year-end items around taxes, tax planning, just making sure if there are things to do before year end, we should think about doing them. Before Raymond and I get started, right, we're going to go through our disclosures. Just remember what we talk about here through our show is not meant to be personalized financial advice, right? If that's what you're looking for, reach out to us directly. But what we describe on the show right now is more for general education and just to talk so that you guys have a better understanding of these topics. In addition, when we talk about investing, right, we're not soliciting for you to buy any particular investment products. Again, it's from an investment education purpose. Same thing with taxes. We're not your tax professionals, right? We're not pretending to be, right? Go ask your tax professionals these questions that we're bringing up, right? All we're trying to do is making sure that you guys are asking the right questions. All right. This week, maybe not as crazy in terms of a market gains as last week, but tell us what we saw, Ray. What did we see in some of the markets? What were some of the numbers?
Yeah, definitely. I mean, this past week, I feel like maybe some people felt just because of all those gains that we saw last week and how crazy it was, there might have been a pullback like this week. So that wasn't the case. We actually saw Dow Jones actually leading the way this week at 4%. We also saw S&P 500 still up at around 2.2%. And it was actually NASDAQ that was the lagging one this week, but actually still up about a little bit under 1% for this week, right? So overall, the market's still up. And I think from what we saw last week, it's not exactly a pullback or a correction that some people might have been expecting. But
No.
It wasn't NASDAQ that usually was leading the way. I think that's going to be interesting for our discussion today. Is that a lot of these work from home stocks actually got crushed, right? So, a lot of what we also read too is a lot of these companies are offering, 10-year contracts or a certain number of contracts where they're allowed to work from home, giving that long period of time of knowing whether they're going back to the office or whether they're just going to be working from home, right, permanently for quite a while. So, we definitely did see some stocks go down this past week. Alfred can speak a little bit about, what they were and kind of our thoughts behind that.
Yeah, for sure. I mean, and look, I think it's fair to even for us, right, with the election going into the election, being a little bit, I want to say fearful, but just anticipating of the idea that there was going to be volatility. I mean, the history says, I'm not going to go into all the data points. I mean, there's so many articles out there right now trying to analyze what November happens right before an election. What does December look like right after the election? Look, at the end of the day, volatility is going to be heightened. That's a fact across all articles. That's consistent, right? We're seeing some of that right now. And it's a good reminder that volatility sometimes happens to the upside. It doesn't always go down, right? It can go up. And we're seeing that. Now this week, right? I mean, why did work from home stocks, right? You see Square, Netflix, Zoom, Peloton. I mean, Zoom and Peloton in particular down quite a bit even today, right? And I would say, you know, it's the idea that there's a potential vaccine out there, right? Pfizer came out on Monday and said that they've had some pretty high success and efficiency in their vaccine.
Yep.
All of a sudden, everyone's like, we are ready to go back, right? Or at least that's the idea in the market, that they look at all these stocks that have just on a rocket ship. I don't even know how to describe, right? Zoom.
Yeah.
Like that stock price just went through the roof, right? And same with something like Peloton. I mean, their orders are through the roof. They've never seen demand like this before. And they're all down right now because people are questioning, are people going to keep these things for the long run, right? Are people going to go back to the gym and not use Peloton? Are people going to drop Zoom as a video conferencing software if they're back to work or back to school? And I think if you ask me, I still think those companies are strong companies in particular. I think that, we're probably getting a little ahead of ourselves in the sense of thinking about how effective this not so much effective, but just how many people are going to take this vaccine. Like Ray's going to talk about, like, it's difficult. I think the process of getting this vaccine is not going to be as easy as people think. And the work from home lifestyle, it's a systemic change. I think that's happening. I mean, we as a company Diversify probably won't be going back to the office for quite a while, right? Because it's a choice that we're making. And that 10-year contract that Ray was talking about, companies are making more permanent remote policies right now happen so that they can make decisions. Families can make decisions about where to go. Yep. I don't think that's changing, right? I don't think that in itself is going to change. And thus a company like Zoom, I think, is going to continue to be successful because people need to use them. Now, I was thinking about this a little bit more. A client asked me, he's like, what about schools, right, that use them? I certainly think schools are one of the segments that Zoom in particular might suffer because they will need to go back at some point, right? That's the better environment for kids to be in, is be in the classroom at that point. You have a situation where, right, the usage of Zoom in those areas may drop off, but I just feel like there's enough companies that are making changes out there that may not have considered using video conference before to serve their needs, right? Same thing as Netflix and Square, right? Square, I mean, they have other business lines as well, but mobile payments, the way that small businesses have adopted using Square for contactless payments, I mean, they certainly saw a surge as well. But again, I would put them into the category of getting hit a little bit because of vaccine news, right? Meaning that there might be more normalized spending and maybe, right, people aren't trying to pick up more Square systems or utilizing Square as much. I still see it all the time. That's one of the things that during this COVID timeframe, the common use of Apple Pay or just touchless payments has gotten so easy to use. I think it'd also be hard for people to scale back from that. Right?
And actually, if I can actually add a little bit to that too, I feel like, with COVID, it definitely opened the eyes of a lot of companies to realize that they can save a lot of money, right? Not having to pay for offices, not having to give the benefits of lunch or dinner or, to their employees. So that's savings to them. And, I feel like the environment's going to change after this, right?
Yeah.
Companies knowing that they can save money like that. I feel like it's going to be switched around a little bit to where maybe before it used to be like 1 or 2 days working from home. Now it's going to be 1 or 2 days going into work and the rest is going to be working from home. And instead of having like a real set office, it might just be like one of those office spaces where if they do want to go in there and socialize and talk about a project, they can, but I feel like it still won't be required to do so. And I feel like this work from home kind of mentality is going to be here for a while. I feel like so.
I agree, Ray. I mean, I think I'm still surprised. By the way, Ray, I'd love to go in the office to see you, right? I mean, that's the thing I probably miss the most is like being able to see you guys day to day, right? So I would love to have that back. But at the same time, I mean, it still sticks in my head that Pinterest paid north of $90 million to get out of their 10-year contract for their new San Francisco location. I mean, that's wild to me, right? Like, of course, they've done the math for that to make sense, but that just shows you the shift that's happening. And those guys aren't going to change anytime soon after paying 90 some odd million to get out of their contract. Okay. Look, I mean, this is right? Like, I think the idea of today's topic about talking through investing and how to invest in a time like this, a lot of it was the election, right? That doesn't happen every year. It happens every 4 years. So that's definitely something that when you now that pair that in with coronavirus, it's been difficult for a lot of people. I'm going to share with you a couple of data points, right? I thought was interesting, right? Because this year markets are up. Markets are doing well. There's a disconnect there, I think, maybe what people are feeling personally versus, I think, how the markets are actually doing. In fact, right, when that Pfizer news came out, so from the post-election to the Pfizer announcement, Dow Jones surged 10%. Okay? It's only happened in that call it 1 week time frame. It's only happened 6 times since the 1960s. Right? S&P surged 8.6% during that 6-day period. Again, 26 times during that since 1960. So S&P has had more chances like that, right, to grow and have these surging periods. But I think when we talked about this internally, and I've shared this with a little bit with clients, the concern is, well, when you have surges like that, I would expect things to come back down at some point. Exactly. Right? That's the idea, right? Like I would expect and to things to come back down. But what was really interesting was that in the year prior to that surge, right, 88 and 89% of the time, the following year period after that surge, right, that index, so Dow, was still positive, or S&P was still positive. So it kind of caught me by surprise, right? Thinking, oh, when you have these huge surges, at some point they're going to come back down. But it could be a conclusion of a couple of things where, again, you stay invested, right? Which we'll talk about. You still have a potential from a probability perspective to still be positive. Don't worry about these minute changes today. The other thing is you have these 10% surges that we're seeing today. Maybe very quickly it comes back down, and then again the next year it's still positive. There's different things that we can see from the data points, but I think the thing that surprised me again was just the idea that from a probability standpoint, 1 year later, it's not right where we're definitely seeing a correction or recession coming, right? Even with these surges, right? And it kind of takes me to the agenda topic, right? Which is how are we, not just us, but like how are we talking to clients about managing their investments, right? Like you combine all these different variabilities, and the most common thing I've heard this year is, I just don't want to get into a market at the wrong time because things are so chaotic. I would say everyone's saying that.
Yeah.
Right. And so the theme of what we really get to and talking about is, okay, I don't care like what is going on in the market, surrounding parts of the market, right? News, headlines, all of that. You have to anchor your investment strategy based off of goals. Okay, period. Yes, things like investment allocation and all of that can be affected by the way that the markets are trending and all of that. I know I'm not, it doesn't, but it doesn't have to be as difficult as that. Like when you have all these decision points come in, it just kind of clouts your decision, right? So we're going to start with talking about anchoring your strategy based on goals. Raymond, what's the first thing there, right? Like, how do we even start by talking about like anchoring the strategy? Like, how do we even know what amount of money we have to invest? Like, where do we start from that perspective?
Yeah, definitely. I mean, if we actually go back to one of the topics that we just discussed before, I think, first off, budgeting is really important, right? Understanding how much you're bringing in, making sure that you're spending within your means, having somewhere close to about a 20%, savings ability of your income that you're making. But from the budgeting perspective, from that point on, we want to make sure that you have at least an emergency fund, right? So a good question that we get all the time is, how much is that emergency fund? So, based upon your budget, we like to see around, 2 to 3 months worth of emergency funds saved up and just sitting as cash, right? That can be in your checking account, your savings account, a CD, a money market, something that's really liquid, not risk to the investments, right? So, about 2 to 3 months, I would say, for double income. So if it's a household with both of you making income, I think 2 to 3 months is a good amount for emergency fund. In terms of maybe one household, but only one income, more closer to about 4 to 5 months worth of your expenses would be good to have as the emergency fund. But the main point of that really is that should anything come up, right? Anything that you have to pay for that was unexpected, you have that emergency funds to sit on and to help pay for those expenses. You don't have to worry about needing
Right.
to withdraw from your accounts or have stressed out about where that's going to come from, right? That emergency fund is just for that sense of security, to help cover at least a couple of months of expenses, any unexpected expenses that come up. And in the case that someone does lose a job, that 2 to 3 months, 4 months, hopefully that's enough time for them to find another job during that time, right? So, that's most important is to figure out, make sure that we have an emergency fund set aside for us. And then it goes back to goals, as Alfred was mentioning, right? Really determining your goals. And what I mean like goals is, trying to figure out what is your short-term goals, your midterm goals, your long-term goals, right? And that's a strategy that we talk about when we invest or create a strategy for a client. But, within short-term goals, Alfred will provide a little more details on this, but things usually within, 6 to 12 months of funds that you'll need, we'll probably want to keep that liquid. Like we don't want that to have you stress about the market does go bad, we can no longer afford a down payment, for example, right?
Yeah.
So, going back to the goals and investing in that aspect, I think that will make it a lot easier for clients to stomach volatility, but also talking about other ways to get into the market too.
Yeah, and like, why are we talking about an emergency fund? Because you can now say that is the money that will allow me to be okay in case I lose my job, right? Because that's what this chaos is causing. Like, I'm worried about if I'm going to be able to work, right? What if I lose my income? What if I'm out of work for a long period of time? You set aside somewhere between 3 to 6 months. For most people, that allows them to have a little bit more confidence in the next pool of money that says, I can actually invest in. Okay, I'm going to talk about how you set those goals, because a lot of people will say, right, Ray, short-term, medium, long-term goal. Like, let's set those goals. I'm not necessarily talking about, long-term goal, I want to retire at this point. I think it's more so like, what is the goal of this dollar that I have in my hand, right? Exactly. So you can easily say, for the emergency fund, the goal of that dollar is to make sure I'm comfortable in case any emergencies happen. I'm comfortable in case anything happens to my job, at least for this period of time. Set it aside. That doesn't have to earn anything, right? Because that low interest, or basically zero interest, is the cost of you buying yourself some comfort, right? So now that that's set aside, you work from your way up. Now, if you're watching this and you're saying, well, Alfred, I don't even have 3 to 6 months of my savings set up. Well, that's your goal. Okay. That's your first thing that you need to work on, is build that up, right? Because once you create that sense of security, it actually can lead to a much better long-term success of your investment. Because the last thing I want you to do is to say, I have this amount in my bank account. I'm going to go risky. I'm going to put this in investment because everyone says I should be investing. You put it in and then an emergency happens and you're actually forced to pull it back out. At that point, right, you have a much higher probability of losing money in a situation like that when you're invested for 1 month versus if you're invested for a year, and furthermore, 10 years or 20 years, right? So you don't want to put yourself in that situation, which is why you set the emergency fund, okay? And then for something like beyond that emergency fund that you've set aside of, again, 3 to 6 months, you're going to ask yourself, well, now I have this extra pool of savings. I'm not sure what the goal is. I don't know. I don't have anything planned for this dollar, because I think that's probably more realistic, Ray. Like people will tell me, I'm just saving to save at this point because I have set aside the emergency fund. Or in your case, you would say, I've also set aside maybe some for renovations and remodel of the home, or a down payment for the home. Yep. Basically, anything that you need within 12 months, you would keep in cash.
Yep.
Right. So then from there, if you're saving just to save at this point going forward, you can ask yourself, do I have some goals set aside for that? If not, you can say, all right, well, you know what? I'm younger. I'm just saving for this for the long run. I probably won't be touching this for 5 to 10 years, right? Then you've set a goal and a timeline for yourself in which you can stay invested with that money. Time in the market is very important, right? And so statistically speaking, right, we've seen a lot of articles that have quoted this as well, but I'm going to share with you some of those numbers, which is if you're invested for less than a month, you have a 39% chance of losing money, right? You're invested for 10 years, okay? That probability of losing money drops to 11.5%. Invested for 20 years, the probability drops to 0.1%, right? So it's not necessarily about, right, trying to always find the best investments. It's finding the most consistent investment and staying true to your strategy, anchored to your goals, so that you can keep the money in without anything coming up causing you to pull it back out, right? And so, you know, I think for me, that is the fundamental way right there to be able to isolate out some of the noise. Okay. But if I'm sitting here with $50,000, Ray, what's like emotionally, right? Because talk a little bit about emotionally too. Like, yes, I have these goals. I've set these goals. I think I have now 50,000 to invest, but it's in cash, right? I've set aside all the things that we just talked about in the last 5-10 minutes. What's your suggestion for someone who's nervous about the market to get invested with that $50,000?
Yeah, definitely. I mean, if someone's already nervous about getting into the market, putting in a lump sum, it's probably not the best idea, because at that point they might just be second guessing themselves or doubting themselves, right? Once again, trying to find a good entry point, which is going to be difficult to do. So, we've seen times where clients just don't know when to put it in because they are, once again, nervous, second doubting themselves, and at the end of the day, they end up not investing the funds ever or for a long period of time, right? So, one way to actually put funds into the market is through something called dollar cost averaging. So with dollar cost averaging, think of this as, with $50,000, we could probably dollar cost average into the market at $10,000 per month, right? So best way is to just select a day of the month, maybe like on the 15th of every month. And on every single 15th, we would just contribute $10,000 into your brokerage account and invest it, right? By dollar cost averaging these funds into the market, we're diversifying the timing risk, right? Because at some points we might buy at the highs of the markets. Some points of the market's not doing well. We're going to buy at the lower points of the market. But it helps us diversify when we're putting the funds in there instead of just putting it all at once as an initial lump sum, the full 50K, because who knows what's going to happen next week, right? But by dollar cost averaging, this also eliminates, the need to second guess yourself by instead just automating your savings there, right? On every single 15th, you don't have to even think about it. Doesn't matter where the market is at that point. Just go ahead and transfer in $10,000 and go ahead and invest it according to the allocation of the strategy that you have, right? A lot of people are already doing this through their 401ks and probably not even realizing it, right? So, every pay stub that you get, a portion of it, if you are contributing to the 401k, is being deducted and putting it into your 401k and purchased at these different price points, right? So maybe if from what you saw, earlier March when the market did dip a lot, you were still putting in new money, buying at this lower price points in March and April, which actually helped you regain your balance or rebound your balance back to where it was originally faster that way, right? Because you're basically putting new money to work at lower price points. So dollar cost averaging is something that we talk a lot about with our clients. It's really a good way to take out that, that nervousness or that pressure of trying to figure out when to put the money in and at least just get your funds invested, but throughout time instead.
Yeah, emotions, right? I mean, I think that's probably the biggest inhibitor to getting invested with that money. And we're just trying to remove a little bit of that. Look, I'm not saying that from a price point, sometimes like it's the most statistically efficient strategy. Am I looking at all the technical data, right? Like, is this the right time to buy in? All I'm saying is it isolates all of that, right? Like it's all this news headlines effect. No, right? What we're really saying is if disregarding some of those things that I just said, I just follow what Raymond talked about in dollar cost averaging, taking the emotion out, setting it on the 15th. What I'm promoting is that probability chart, right? That if I can get invested today without thinking about it and without timing it and stay invested long term, I like our odds, right? I like our odds of succeeding, which is continuing to grow that money. But it has to start, right, with that emergency fund, kind of like building a building block, right? You're continually stacking on top of it to be able to say, I've got this layer taken care of. I've got the emergency fund, anything above that. Now I can follow this dollar cost average strategy to get back in. And look, it works, right? Because our clients have those same emotions. We have those same emotions,
Exactly.
right? There are times that you make a decision about pulling money out of the market. Maybe you did it this year. Guess what? It's okay, right? The longer you wait right now, right? The longer you wait right now, the harder you're going to hit those long-term investment, right? Strategy timeframes that I talked about. You're never going to know when the right time is, right? And I think that's the difficult part is most people thought waiting after the election, you're going to have a good time. We have not. Markets have gone up like crazy, okay? And so the longer you wait, the harder it is to recover, right, from that actual losses from what the potential gain would have been.
Yep.
Right. So to summarize there, right, set yourself some boundaries, set yourself some baseline fundamentals about identifying what you actually can invest. I call that your investable capital. Okay. Once you've identified your investable capital, it means you've set aside money that you know you need for the 6 to 12 months. It allows you some more freedom with the cash that you have to get invested, take that cash, use a dollar cost average strategy, isolates out some of the noise. Okay. Great. So it is almost towards year end, right? Which I've already got the Christmas music playing. I don't care what you say out there. If you think it's too early, it's already happening. Okay. So my team just gives me so much for that, for playing Christmas music early, right? Including you, Raymond. I know, but you're like, it's not even Thanksgiving yet.
He was trying to start in August, so it's just
okay,
not really
August. Maybe I was a little pushing it, but I tried. We are towards year end here. And so there are some financial decisions, specifically tax decisions to think about. So Raymond, give us a couple, three things, right? We're running short on time. What are three things what we should think about from a tax perspective or just end of year perspective that we should think through?
Yeah, definitely for taxes, we definitely want to make sure that we're looking at a tax projection for the year, just so that come April of next year, there's no big surprises. So, definitely looking at your pay stubs to see how much you withheld for federal and IRA, and federal and California. And then, for this year, I feel like a lot of people might have received some unemployment benefits. So I wanted to talk a little bit about the taxes there and people that aren't familiar with it, right, and how that impacts their overall finances.
Yep.
The other two would be charitable donations, right? So people who are looking to donate to charity this year, just know that they also have a calendar year deadline, so December 31st. Usually from what we see, if you're creating donor advised funds, for example, they get pretty busy in December, so definitely want to get a head start on that now if that is something that you're interested in. The last item is going to be tax loss harvesting, right? So people that have brokerage accounts where maybe they had big losses this year, might want to look into some of the cost bases and sell some of those losses to kind of offset any of the gains that they have. But definitely want to look and kind of strategize around that.
Yeah. And so, and to expand on that just a little bit as well, charitable donations, you got to make sure too, it's not just donating anything for anybody, creates a tax deduction for you. It has to be some particular situations. Of course, it has to go to qualified charities. Let's just assume that that's the case. But on your tax return itself, if you are someone who takes what we call the standard tax deduction, right? Then donating may not help you as you would thought. Okay. You actually need to itemize your deductions, and it's not necessarily a choice. It's just, do you have enough deductions to go above the standard? And if you do, a donation will help you. Okay. If that's a question that you want to talk about, you should definitely talk to your tax professional and say, is a donation really going to help me? Because everyone talks about how donating, right, is tax deductible and you should do it. It's in very particular situations that it can. Okay. I really like that thought, Raymond. You talked about unemployment benefits because a lot of people received unemployment this year. A lot of people who do that get a surprise tax bill at the end of the year. Okay. While it's not taxable usually to state, like in California, unemployment isn't taxable to California. It is taxable to the federal side. And unless you made an election to say, please withhold taxes for me when you were receiving the unemployment payouts, they did not take taxes for you. And it causes a decent surprise at the end of the year, especially in a tough year where you had unemployment, right? You're kind of pinching pennies here. To receive a surprise tax bill in April would not be fun. Okay. So if you're watching this and you receive unemployment, think about that, right? That income likely did not have any taxes withheld for you. Okay. Again, For us, these tax concepts and tax education is so that you can start asking the questions about what happened this year in your situation, so that if you're working with a tax professional, if you want to reach us to have questions, feel free to let us know. Be happy to help there. Otherwise, closes out another Dfi-nancial Friday show for us. And it's been a lot to talk about, hard to fit into 30 minutes, to be honest. But we're glad that we're here and happy that we can share these thoughts with you guys. And we'll continue to have these shows to share with you what we're seeing in the past week from our clients from a financial planning perspective, and just give you a little taste of what we're seeing in the markets in a more simplified way. Okay. Thank you again for joining us. Again, my name is Alfred from Diversified Capital, with Raymond joining me as well.
Thanks, everyone. Have a good weekend.
Bye.
Bye.